The maximum drawdown limit is set for a reason, but the projected alpha demands higher allocation. We have to override the rule here. It's too dangerous.
Every trader asks the same question. How much should I risk per trade? Pause. But almost nobody asks the more important one. What happens if I get this wrong? Beat, because the truth is, this single decision determines whether you survive long enough to ever become profitable. Scene 2. The reality check. Montage of traders celebrating, then losing, then quitting. Narration. Let's get something straight. Trading is not about making money. Pause. It's about not losing everything. Because if you lose your capital, you are out of the game. Cut to empty trading desk. No strategy matters, no setup matters, no psychology matters. You're done. Scene 3. Define risk per trade. Risk per trade is simple. It's the percentage of your account you're willing to lose if a trade goes wrong. Not what you hope to make. Not what you feel. What you're prepared to lose. Example. If you have $1,000 and you risk 2% per trade, that means every loss costs you $20. Scene 4. The dangerous lie. Social media clips. Turn $100 to $10,000. Beginners don't follow this. They risk 10%, 20%, sometimes 50% per trade. Cut to fast rising equity to sudden crash. Why? Because they're chasing fast money, and they believe one trade can change their life. Pause. But it usually does. Just not the way they expect. Scene 5. Consequences of ignoring risk. 1. Drawdowns become fatal visual. Graph dropping steeply. Let's say you lose 50% of your account. To recover, you don't need 50%. You need 100%. That's the trap. 2. Emotional collapse visual. Trader sweating, revenge trading. When risk is too high, every loss feels like damage. You stop thinking, you start reacting. 3. Inconsistency. Random trade entries. High risk creates unstable results. You win big, then lose bigger. There's no structure, no system. 4. Account death spiral visual. Balance dropping to zero. Eventually, one bad streak wipes you out, and every trader has losing streaks. Scene 6. Beginner versus professional. Split screen visual beginner trader risks 10 to 30% per trade. Focused on quick profits. Changes strategy constantly. Emotional after losses. Overtrades. The beginner is trying to win big. Professional trader risks 0.5% to 2% per trade. Focused on survival, executes consistently, accepts losses. Calmly thinks in probabilities. The professional is trying to stay in the game. Keyline. Slow emphasis. Beginners trade to win. Professionals trade to last. Scene 7. Position. Sizing breakdown, step-by-step position sizing. Narration, let's make this practical. Example, account, $5,000 risk per trade, 1% risk amount, $50. If your stop loss is 50 pips, then your position size must match that $50 risk. Important, not the other way around. You don't pick a lot size and hope. You calculate risk first, then size your trade. Scene 8, the power of small risk. Smooth upward equity curve. Narration. Small risk looks slow, but it's powerful. Example, risk 1% per trade. Win rate, 50% risk reward, 1 to 2. Over time, you grow steadily. No drama, no panic, no destruction. Keyline. Consistency beats intensity. Scene 9, drawdown control. 2 accounts side by side. Trader A risks 10% 5 losses, account down approximately 40%. Trader B risks 1% 5 losses, account down approximately 5%. Narration, same losing streak, completely different outcomes. Key insight, risk controls drawdowns. Drawdowns control survival. Scene 10, the psychology of risk. Calm trader versus stress trader. Narration, when your risk is small, You think clearly. You follow your plan. You stay objective. When your risk is large, every tick feels personal. You interfere, you sabotage yourself. Keyline: good risk management protects your psychology, not just your capital. Scene 11, capital protection. Mindset, vault closing over money. Narration, professionals think differently, they don't ask. How much can I make? They ask, how much can I lose without damage? Because capital is your weapon, and if you lose it, you can't fight. Scene 12. Consistency is built on risk. Calendar with repeated trades. Narration, you cannot be consistent if your risk is inconsistent. Same setup, same risk, same execution. That's how professionals operate. Scene 13. Realistic expectations. Slow upward curve versus hype content. Narration, you will not get rich overnight with 1% risk, but you will. Stay in the game, build discipline, develop edge, grow sustainably, and that's what actually leads to long-term profitability. Scene 14. The truth about losing streaks. 10 red trades in a row. Narration, even the best traders lose. 5, 7, even 10 trades in a row. The question is not if it happens, it's whether you survive it. Trading is not a sprint. It's a survival game. The traders who win are not the smartest, not the fastest. They're the ones who are still here. The one rule, ending. If you remember nothing else, remember this. Never risk more than you can afford to lose. Repeatedly. Pause. Because one trade doesn't matter, but survival does. The Trading Jagaban narration. Trade smart. Protect your capital. Stay in the game.